Hey guys, hope you and the families are doing well. This video is designed to help you improve your swing trading by giving you a better framework to think about your systems and routines that you're implementing in your trading on a daily basis and also a weekly basis too. I'm going to touch on relative strength, which I think is very, very important when you're thinking about the identification stage of a trade. So identifying a high quality setup. So we're going to be working for a framework of thinking about the four main areas of every single trade. Number one, you've got to identify a high quality setup. Number two is how do you go about controlling the risk to create asymmetric risk versus reward trading opportunities. Number three, how do you go about mitigating the risk, go free rolling the trade and taking all of that risk out of it. Number four is how do you optimize the profits? What are selling rules and guidelines that you can implement to help ride those big trends when they play out? MarketSmith are today's video sponsor. You'll see a couple of the charts from the stocks I'm going to be showing you during this video. If you're interested in a discounted trial, then there is a link in the comment section down below. So let's just start here with NVIDIA. I'm going to be taking you through recent trades that I've been in and been targeting. So with NVIDIA here, you can see the four elements of the process: identify, control, mitigate, and optimize. So number one, how do you identify a high quality setup in a leading fundamental stock and a leading technical stock as well? We're going to be more so focused on the technicals in this video, but NVIDIA is actually hitting a 52-week high on my relative strength line whilst it's still within the base and preemptively trying to come out of this base as well. That is a significant sign of strength as well. Then it's about controlling the risk. So you can see here my initial risk on the trade is around about 2.25%. That's very, very tight indeed. And then what I was able to do is sell 1/3 of the position here at 289.64, which you can see at 289.64 on the brokerage statement to free roll the position. So now I've got 2/3 of my trade there hypothetically risk free. Yes, that can be gap downs on an earnings or something like that, or potential slippage when you're getting stopped out. But hypothetically, I've now been in the position for 2 days. I've got 2/3 of my position effectively risk free. Now I can go and ride an intermediate term trend. So for me, I'm an intermediate term trend follower. So that is how my process and my systems and routines are designed and developed. So then you can see NVIDIA starts getting extended from the 10-day EMA here. Okay, really good reaction to the earnings, but clearly it's extended here. There's a supply shoot, there's increased volume, it's extended from its 10. So what I do is with 1/3 of the position, I just put my stop loss on the low of the bar. Why? Because there's a high probability NVIDIA is going to pull back in to its 10-day EMA here. So I just choke the position off by using 1/3 of the position, adjusting my stop loss to the low of that bar, and maybe there's an opportunity to add. I actually added in a different account up here as it was tightening up. Is actually through this day here off this little shakeout demand tail. You'll learn about those. And then finally, NVIDIA broke the 50-day moving average. Now usually I would use the 21-day, but for NVIDIA I wanted to give it every single chance because I thought it's a proper leadership stock, huge earnings, huge sales, huge estimates going forward, leader in the AI space as well. So I'm going to use the 50-day moving average, but you can see it's decisive break for it. So I'll give you every chance NVIDIA to bounce, but place my stop loss there, and then you can see taking out that at 420.30, which is that exit there for 420.30. So this is what we're going to be working through, and this is kind of the ideal trade, right? You get in, it's tight initial risk, you can free roll it early, and then you sit for a big intermediate term trend utilizing some of the selling rules. So that could be choking it off when it gets extended from the 10-day EMA, but trying to ride key moving averages. Black line is the 10-day EMA, blue line is the 21-day EMA, and the purple line is the 50-day simple period moving average. So let's just start working through this. Okay, if you're a swing trader, there's kind of two. I kind of think of it as there are two types of swing traders. You could have an active swing trader and you could have a position swing trader, and I'll let you read these bullet points for yourselves. Okay, but for active and position swing traders, there's four parts to every single trade. So it doesn't matter if you consider yourself as an active swing trader or a position swing trader, or even if you're a day trader, or however you define yourself. Okay, number one, you need to identify a high quality setup, which is what is going to be a significant part of this video. Number two, how do you control the risk to create asymmetric risk versus reward trading opportunities? I'll take you through that with some examples. How do you then mitigate the risk to free roll positions? Now you don't have to do that. I do like doing that. That's just me, my process, and how my brain works, how my psychology works when I'm in positions too. I feel like when I free roll a position, it reduces a lot of stress, makes it easier for me to sit for that intermediate term trend to play out. And then number four, what are your selling rules and guidelines to help you optimize profits? So do you know what you're doing in each four of those system areas? If you don't, having any sort of consistent system and routine is going to be very, very difficult for you. So it's about building systems and implementing them into your routine. So what are your systems? What are your routines? So here you can see this is the systems area. Okay, so how do you identify a high quality setup? What do you think? Wow, that is an absolute exceptional setup. That's one I want to be targeting. Now, obviously, there's subsections to this. How do you go about finding those? How do you screen for those? There's other videos on the channel around that. So how do you go about identifying it? Then how do you control the risk? Create that asymmetric risk versus reward trade. Now, this could be different. If you're a day trader, how you go about controlling the risk will be different to if you're, say, an active swing trader whose initial stops are maybe somewhere between 1% and 4%. If you're a kind of longer term positional swing trader, well, you're going to control the risk differently as well, and your setups may be a little bit different as well. But you're controlling a risk where it may be somewhere between 4% and 8-ish%. It kind of depends on the setups that you like, how much room you want to give them as well. Now, obviously, risk is a function of expected reward as well. So if you're a position trader, you're probably going for bigger gains than, say, a day trader or a much more active swing trader. Then you can go about mitigating the risk, and maybe you want to do that, maybe not. It's down to you. And then how do you go about optimizing profits? Eventually, you're going to have to sell, right? Unless you're Warren Buffett and you're just going to hold Coca-Cola forever. Eventually, you're going to have to sell. So what are your sell rules? What are your guidelines around optimizing profits? And this comes from a deep understanding of how do stocks move pre-base, in the base, what do they do afterwards? And you're building your systems around that. Now, how do your systems fit into your routines? And I've split the routine into this manner here, because you have post-market, you have pre-market, and then you have when the market is open. So in terms of market time, there's only 3 times. There's post-market, there's pre-market, and there's when the market is open. So what are you doing in the post-market? What are you doing in pre-market? What are you doing when the market is open? Now, my brain, it craves discipline and structure. So that's why I'm really drawn to the market, because the market opens at the same time every day. I can't ring up the market and say, hey, wait, I'm going to be 20 minutes late today, hang fire. The market doesn't know who I am. It doesn't care who I am. The market opens at this time every day, closes at that time every day. Obviously, there's exceptions when it's a shorter session, if there's bank holidays and stuff like that, but hopefully you understand the point. So we all have different lifestyles, different commitments, different family commitments, could be time zone difficulties as well if you're in Australia and you're looking to trade the US market or something, but you have to design your systems and your routines to fit into what it is you are trying to accomplish. So there's a great quote, Atomic Habits by James Clear, exceptional book, top 3 books I have ever listened to on audiobook. I prefer audiobooks than reading books, just quicker. And when I'm on daily walks and doing active meditations when I'm walking, and just listen to a good audiobook, okay? You do not rise to the level of your goals. You fall to the level of your systems. That's so good, I'll repeat it for you. You do not rise to the level of your goals. So your lofty goals and desires and what it is you want to do in life, it doesn't really mean anything. It's about the systems that get you to your goals. What are the systems to get you to your goals? If you want to lose weight, for instance, it's great having a goal that I want to lose a stone before summer or something like that. But if that's just your goal and you have no systems behind it, you're never going to achieve your goal. It's the systems that get you to your goal. Okay, it's the systems that get you to your goal. So what are the systems that you are implementing into your daily and weekly routines? It's really, really important. Really important when trading. People just overlook it. It's so important. Cannot stress it enough. So I'm going to take you through a couple of trade examples, and I talk about the identification as well. And then a little bit later on, I'm going to run through a bar-by-bar example in PANW Alto. Okay, so I'll talk you through how I identified it, how I kind of set it up from a systems perspective into a routine perspective, or a routine example as well. So I can just take you through it bar by bar, explain my thought process as we are going. So PANW Alto, VRT, and Meta. Okay, this is the 6th of October 2023 weekday video. So this is the weekday video. These are the 3 stocks I'm targeting. This is the market health tool and the summary. Okay, over here. Okay. So this one here, PANW Alto, we're now going to get into the relative strength as well point, okay? So this is key in terms of identifying. So something that I really want you to take away from this video is understanding systems and routine, thinking about your own systems and routine, but also the importance of relative strength. This is going to be key. So key. So PANW Alto, I was buying it on this day here as it came through this level. You get this tight, what I call a trigger bar. Those of you who've watched the blueprint video will understand what trigger bars are. It's on the channel, you can just search for it, okay? So through the high of this bar, so my entry is 237.41, and then I free rolled the trade at 239.79 on this day here as it starts to get out. This is the one we're going to go bar by bar through a little bit later on. But let's get into relative strength, okay? So at point number 1, what is stronger? The stock, PANW Alto up here, or the market? Okay, the SPYs. What do you think is stronger? Well, at number 1, you've had a really good reaction to the earnings, and the stock is actually making a higher high at point number 1, whereas the market is not really going anywhere, and it's actually made from this point here, from September to this point here, the 1st of September to the 11th of September, it's actually made a lower high. So PANW Alto is stronger here. Now at point number 2, PANW Alto loses some of its key moving averages, but it's being dragged down. See this decline here? It's being dragged down by the weakness in the market. But what is weaker, the market or PANW Alto? It's the market. Look how viciously it's just sold off here, and look at the key moving averages, and look how close the SPYs is to its 200-day moving average, which is the red line here, whereas Palo Alto is doing its best to hold up, and the candlesticks are pretty tight and the volume's pretty low as well. On this whole decline in here, there's not a single volume bar. This one comes close, but this black line's the 30-bar average volume. There's not a single volume bar above the 30-bar average in terms of the volume. That's telling me there's not that much supply. And actually, when you see the pop in volume here, you actually get what I call a shakeout demand tail. That's an absorption type candlestick. It's like a hammer type candlestick. And then you get the tightness and price here. So at point number 2, Palo Alto is stronger. And then at point number 3, well, the market's actually made a lower low here, and it's on its 200-day moving average pretty close, and you get the shakeout demand tail, whereas Palo Alto has actually just kind of gone sideways to up here and is starting to tighten around a clustering of key moving averages. The 10 EMA being the black line, the 21 EMA being the blue line, and you get the purple line being the 50-day moving average, the grey one is the 100, and then you get this tight, what I call trigger bar. And the prior day, look how it opens on the low, pushes up, then you get this tight inside trigger bar action, and look how the volume's just dried up as well. So this here is a little cut with a low handle that's forming here, or a low cheat if you like that kind of terminology as well. But this here is where you can get a really asymmetric risk versus reward trade, and Palo Alto has been telling you it's much stronger than the indexes. If the indexes are going to bounce, this stock has a really good chance of being one of those leadership stocks over the next, depends how long the market's going to bounce for. Maybe it's a couple of days, maybe it's a week, couple of weeks, couple of months, who knows. That's the nature of the beast, and then trying to sit for intermediate term trends. But look how this relative strength line as well, free tool on TradingView, you can find it. Look how the relative strength line is turning up here as Palo Alto is building the pivot. It's a really, really good setup. So these are the common type of chart patterns that you're going to see throughout this presentation, the ones that I look for. So most entries occur in variations of these chart patterns. So that could be your flags, triangles, pennants, cup with handles, flat base, which is also known as a Davis box, a wedge type pattern. These are the type of bases that I'm targeting, both in terms of daily charts, but I also like to see them on weekly charts as well. But I will drill down and look for that entry on a lower time frame, such as the daily chart, when it's sitting on key moving averages, and I get what I call an optimal candlestick for an entry candlestick. So that's variations of shakeout demand tails, which I covered extensively in the blueprint video. It's also gap down reversal bars as well, so piercing patterns, thrusting patterns, bullish engulfing type candlesticks, but it's occurring in one of those optimal bases, sitting around one or more key moving averages, and the risk has to make sense as well. There's also then trigger bars as well. So trigger bars are often tight, low volume inside bars, and they could occur inside, say, shakeout demand tail, and maybe you then get back-to-back inside bar, or maybe get a gap down reversal bar and a back-to-back inside bar, or it occurs as an inside bar after shakeout demand tail, or an inside bar after a gap down reversal bar, a bullish engulfing candlestick. So there's variations of setup, but it's about understanding optimal chart patterns, optimal entry candlesticks, understanding statistics around them, trying to then pinpoint that it happens on one or more key moving averages. Does the risk make sense as well? So this one here, this is VRT. So the entry is here, coming through the high of point number 3. Okay, so the entry is at 38.62, and then I free roll it at 39.73. Now I'm being quicker to free roll in this market because it is what I deem to be a choppy, hostile market environment. So I'm much quicker to free roll. So that third part of the trade, so you got identify, you got control, you got mitigate and optimize. The third part of the trade, I'm quicker. When the market is more difficult, and it will ebb and flow, between a healthy breakout environment where things are going well, it will then be a choppy market environment, it will be a hostile market environment, maybe it goes back to choppy, then back to hostile. But for me, when I deem it is on a choppy and hostile market environment, the third part of the trade, the risk mitigation, I will speed it up. I will speed it up and get the risk out of the trade earlier on. Okay, so let's just run through VRT here. Okay, at point number 1, what is stronger, VRT or the SPYs? Well, if you look at VRT, great reaction to the earnings. If you look at this high point coming through here at point number 1, VRT is making a higher high, whereas the S&P 500 is making a lower high. So what's stronger? It's the stock as well. And then you can see all of these 52-week highs. The market won't miss the best opportunities, guys. The market doesn't miss it. There's too many smart minds. You are competing against the best of the best in the market, and they are all trying to take your money, and you're trying to take their money. It is a brutal market to be operating in. You need to understand it is probably the most competitive area in the world to be competing in, the stock market. It is vicious. You need to be on it. So this here, okay, VRT, you can see that it's making a higher high. Really, really good. 52-week highs on the relative strength line. Checks, acting well. Above all key moving averages. Then at point number 2, okay, VRT from this point here to this point here makes a higher low. It is strong. Whereas what does the S&P 500 do? It makes a lower low to point number 2. See how it's made a lower low? So the S&P 500 is making a series of lower highs and lower lows. Definition of a downtrend. Whereas VRT is doing its best to hold in there given the market weakness. And this is the key point. When the indexes are correcting or they're in pullbacks, this is when leading stocks will build bases. So pullbacks and corrections in the market, so the Qs and the SPYs, is very good because leading stocks will base. They will hold up, they will show their hand by holding up, displaying relative strength, and building an optimal chart pattern. That is my belief system. I've just seen it happen too many times. Then at point number 3, what's stronger? Well, the S&P makes a lower low and sits here on its 200-day moving average with a pretty much inside bar shakeout demand tail, so a doji hammer type candlestick there. But VRT has put in an inside candle sitting on its 1021 EMA. It's built this little kind of low pivot in here. Look at all the 52-week highs. One of the strongest sign of strength a stock can possibly give you is a 52-week high, and it's still in the base on an inside bar. Like, that's ridiculously strong. It's telling you the market is going down, but the market weakness cannot pull the stock down. It's really, really strong. It's a really strong stock. Now, this is Meta here. So this is from one of the weekday videos. So every weekday ahead of the session, okay, I will do a weekday video. So this is Meta where I'm blabbering on about it in the video for members. So here, it's a gap down reversal bar, then a shakeout demand tail in Meta sitting on the 1021 and 50-day moving average. Here is how I'm thinking about it and planning the trade out. I'll take you through this in more detail on PANW a little bit later. So let's go into the thought process a bit more on Meta, okay? So if you look at point number 1, what's stronger? Is it Meta or is it the S&P 500? Well, Meta actually makes a higher high here, and look how price was able to rally, while the S&P 500 is flat to down, and it's actually making a lower high. So at point number 1, it's making a lower high relative to this high at the 1st of September, whereas Meta's making a higher high. Meta structurally is stronger. You also get over here gap down reversal bar and a nice shakeout demand tail for Meta. Now at point number 2, there's a big shakeout demand tail. Now I was actually targeting it through the high here of this. You get this nice, it's a gap down reverse bar, then a trigger bar. So I actually was targeting it through the high of this bar here, and I got in, and then I got stopped out here on this shakeout demand tail. But if I get knocked out on a shakeout demand tail, stock's still going to be on my radar because it may reset, which it then does at point number 3. But at point 2, Meta puts in a big shakeout demand tail, isn't going down. Note how well it's just trying to hold up in this vicinity over the last 5 bars, whereas look at the last 5 bars prior to point number 2 for the S&P 500. The S&P is going down, the market is going down, the market is weak, whereas Meta's just going, no, 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 I'm just going to hang on in here. Someone somewhere, or quite a few people if you think about the size of Meta, are supporting Meta. Why are they supporting Meta? I can't go and do a questionnaire and ask them, hey, why are you buying Meta? Why are you accumulating? Why I can't do that. Right? But I can visually see they're supporting the stock. It's all there in the charts. It's right there. Meta is telling me it's very, very strong, especially with this shakeout demand tail that yours truly got caught in as well. So I had a small loss on this one. I think it was like 1.5%, something like that, because I threw the high, stop underneath the low. Maybe it was closer to 2%, but it was like 1.52%. It was a really, really tight initial stop loss. That's why I like trigger bars as well. Okay, and then at point number 3, you get a gap down reversal bar, then an inside shakeout demand tail. So you get a gap down reverse bar, inside shakeout demand tail, now above all key moving averages, the 10, the 21 and the 50, and look where the index is. Okay, it's near its 200-day moving average, shakeout demand tail, okay, but look at the difference in the strength of Meta. Look at the 52-week highs in the base. What did I tell you on VRT? If a stock can hit 52-week highs, these blue dots here, search my name on TradingView, you'll find it. It's a free indicator, it's brilliant. Okay, if a stock can hit 52-week highs in the base, it's telling you it's extremely, extremely strong. Now, foolishly, I was targeting it through the high here with Meta, and then it gapped down, so I cancelled my order because the first 15 minutes it gapped down and I lost interest in it. I like to see them go. So should I have cancelled my order? No. I invariably use a buy stop limit order with a stop loss attached, as I'll teach you on PANW. So I shouldn't have cancelled the order here. It gapped down to the 50, held it, and then went intraday. I wanted to see it go quicker. I cancelled the order. So this one I didn't actually take, albeit you can see that I was targeting it heading into the session, and you can see it from here as well. I was targeting it. These are the levels where I was targeting Meta, okay, through the high of that shakeout demand tail, which was an inside bar. Let's do rally as well, okay? So this one here is rally. This was in the weekday video. So you get the shakeout demand tail just underneath the 20, 10, and 21-day EMA. It's building in this higher lows. Look at all the 52-week highs. So this is from the weekday video, which goes out ahead of the market opening. That's what I'm planning and preparing to do the next session. So number 2 is the entry. Now, I actually cancelled the order on this one. I should stop cancelling orders, right? Because it was a little bit funky in the first couple of minutes, didn't like the intraday action, and then it decided to go. So sometimes I can be cancelling orders, and then the market opens, I overthink it, I see some action I don't really like, and I cancel the order. Sometimes it happens, right? But why was I targeting Melly on this day anyway, and then kind of somewhat bottled it by cancelling the order? Hindsight 2020, I shouldn't have done that. But why was I targeting rally? Okay, point number 1, what's stronger, the stock or the index? Well, the stock is up here making a series of higher highs, higher lows, higher highs, higher lows, right? Great reaction to the earnings, 52-week highs, while the index is generally doing the opposite. It's doing vice versa. It's making a series of lower lows, lower highs, lower lows, lower highs. So the stock is much stronger, way stronger. Then it starts building this nice multi-week base, starts hitting 52-week highs. And you could see in this vicinity here, around the middle of September, the stock's trying to go. it's trying to go. Look at the 52-week highs. It's trying to go, but look at the weakness of the market. The market's just not letting it. So at point number 2, where I'm then targeting the entry, okay, look at the market down here near its 200-day moving average, but rally just puts in this nice inside bar, pretty much an inside bar, shakeout demand tail, closes on the high. The volume is around about half to a third versus the 30-bar average. Shakeout demand tail, low relative volume, higher low. This amount of relative strength tells me there ain't much supply, there ain't much selling for rally, and the risk makes sense. Then what I'm trying to do is free roll into the pop, sit through the testing action, then play the stock for a bigger move. So look at point number 3. You need to get back-to-back inside bars. Look at the strength of rally. See how this relative strength line is just, again, subtly turning up. So on bar number 3, look at the bar, look at the candlestick you get for the S&P 500. Red bar closes down for the day, can't get above these key moving averages, whereas rally's just going, no, I'm just gonna hang on in there. If you just looked at rally, you wouldn't even know there's weakness in the indexes. Maybe you would if you looked at the relative strength line, but if you were just looking at a price chart and the volume, you wouldn't even think the indexes are weak. This is the point about focusing on the leading stocks. It's really, really key. So what I'm now going to do is take you across the trading view, and we're going to go bar by bar on PANW, and I'll really explain the thought process of how I am then identifying the trade, thinking about controlling the risk mitigation levels as well, and how I go about free rolling the position. So we've got TradingView loaded up, and we're going to go bar by bar for PANW on the day before I enter the position. So I do my screening before the market opens. So everything, my trading plan is planned out before the market opens. That feeds into my daily systems and routine. So we're going to be working through this from 4 main phases. Number 1, let's identify a high quality setup. Number 2, control the risk. Number 3, mitigate the risk, and I'll be explaining that very thoroughly to you and different scenarios, different options around that when the stock starts moving out. And number 4, we'll briefly touch upon optimizing profits. So in terms of the identification, we've already covered it in the presentation, but it's a cup with a mid to low handle, low cheat, whatever you want to call it, showing a lot of relative strength versus the S&P 500. The relative strength line is turning up as the stock is building this pivot, and then you get this tight inside bar sitting on the 10, 21 and 50-day moving average, and the prior bar is actually really good. Opens on the low, pushes up, subtle sign that there is demand for this stock. Now, the way I invariably plan the trades out is I like to look for trigger bars, I like to look for shakeout demand tails, and I like to look for gap down reverse bars. Now, this is a trigger bar, which will commonly take the form of a tight, low volume inside bar, and you'll see that I plan the trade out here. So through the high of the bar is 237.30, a stop loss 1 cent below the low is 234.34. And you'll see that comes out at 1.25% initial risk, assuming perfect execution. But we don't just factor in perfect execution, we have variations around that, and I'm going to teach you about a buy stop limit order with the stop loss attached, which is my preferred entry method in terms of order entry technique. You will also see in the upper right corner here, we have an ADR percentage, which is 2.16%. What on earth does that mean? That means the average daily range percentage over the last 20 days, excluding gaps, this stock has moved 2.16%. Now that's important to me for several main reasons. Number 1 is when I'm thinking about controlling risk, I like to get my initial stop loss, so currently 1.25%, assuming perfect execution, but we're going to talk about that and actually increase it somewhat. I like to get my initial stop loss half to 2/3 versus the ADR percentage on trigger bars like this. Now, there are shakeout demand tails and gap down reverse bars that I'll target. Those bars inherently are wider than trigger bars, so it's not uncommon for the initial stop loss to be around the ADR percentage on a shakeout demand tail or a trigger bar. Anything more than 5% though, and I'm probably not going to be targeting the trade. 5%, remember I'm a swing trader, intermediate term trend follower, so for me initial stop loss over 5%, I think it's got to be a really, really good setup and probably quite a quick moving stock as well. So what I'm doing here is I'm assessing the initial risk versus the 20-day ADR percentage, which I think is a good metric. So 1.25%, it's not quite half, but it's less than 2/3. It's pretty good, it's pretty tight. Now this assumes perfect execution as well. It also helps me in terms of the third phase of a trade, which is risk mitigation. So what I'm trying to do is I'm trying to then sell part of my position. Now that could be half of the position, it could be 2/3 of the position to free roll the trade. I will be quicker to do this as well in choppy and hostile market environments, which is discretionary by me. That's looking at a lot of different metrics, a lot of different things in terms of how am I performing, how are stocks performing, what am I seeing in the indexes, how many setups are there. There's a lot of things that go into it, but it is a subjective view, it's a discretionary view for, okay, I think we're in a choppy market environment, I think we're in a hostile market environment. At this point here, I was in a choppy market environment, so I want to be quite quick to be mitigating the risk. So these are then my levels, assuming perfect execution. I could sell half of the position at 240.26 to free roll the trade. Obviously, hypothetically, you can get gap downs, you can get slippages and things like that, or I could sell 1/3 of the position at 243.22. Now I use the fib retracement tool. Okay, to do this, I use this one in here like this. Okay, I don't know why it's just done it like that. Let me just show you the settings that I use for this one here. Here you go. Okay, I will set it up like this here. So 0 is going to be the stop loss level, 1 is going to be the entry level, 2, that is going to be the free roll target for half the position, and 3 is going to be the free roll target for 2/3 of the position. That there is how I set it up. So let's go back here, put the volume on. Now what I'll do is I'll drop it down onto the 1 hour chart. Okay, now what I quite like to see on the 1 hour chart is for the 10, the 21 and the 50 simple period moving average to be in close proximity when I'm targeting, when I go down from the daily chart to the 1 hour chart. I use multiple time frames. Okay, primarily I'm looking at the weekly, the daily and the 1 hour chart. I spend most of my time on the 1 hour chart. So let's now just minimize the relative strength line for a second. So I'm planning the trade out, and let me take you through how I think about it. So I'm planning the trade out, and at the minute, I'm assuming perfect execution. I can see there's nice tightness in prices. Actually a really good session when you break it down. There's a shakeout demand tail, inside bar, bullish ease of movement because price easily moves to the upside on low volume. Then there's a shakeout demand tail. Then there's 3 pretty tight candlesticks to close out the session. That there is nice when you think about it from a supply and demand perspective. So what I'm going to do is I will invariably, certainly if it's a bigger stock, I want to buy it within 0.5% of the high of a trigger bar or a shakeout demand tail. So we're just going to set this up, and this is how do it every single day. Remember what I've been saying, systems and routine. So 238.48, okay, 238.48. So when I then plan the trade out like this, 238.48, what I'm doing is, this is how it feeds into the broker again. Let me just put this in here like this. So this pink level here, what I'm looking to do is get, when price moves through the high of the trigger bar, which is 237.30, I want to get filled somewhere between 237.30 and 238.48. Now, why do I want to do that? Because I want to control the risk. I want to define how much risk I can have on the trade. So this then all feeds into the risk mitigation and having a plan. So if we put this in here at 238.48 and we put the lower one down at where our stop is going to be, I now know that on the position, I'm even going to have, if I swap these around, it may be easier for you guys. Okay, I know that I'm going to get filled somewhere between 237.30 and 238.48 if I get filled on the position. Now, if the stock gaps up here to like 240, 241, I'm probably just going to cancel the order because I don't like gaps above the level where I'm looking to get. I just don't want to play. Some people like gaps. I don't like gaps. I just like it when it moves through the level. From a trade management standpoint, much easier for me, as I'm going to be showing you. But I have now defined how much I'm willing to pay for any shares utilizing a buy stop limit order with a stop loss attached. Really helpful for me because now I can work out my free rolling targets as well. So now I know if I get filled at 237.30, well, I could sell half the position at 240.26 to free roll the trade, or I could sell 1/3 of the position at 243.22 to free roll the trade. However, if I was to get filled higher up, so let's just go here and let's put this price bar in here at 238.48, you're now going to see this purple level and the green level change. Okay, my targets now become higher. If I get filled at the upper range of where the limit is, so the maximum I'm willing to pay for any shares, as I tell interactive brokers, at 238.48, well, now my free roll targets from being filled at that level and keeping my stop loss down here at 242.62 or 246.76. Okay, so now I know where the free roll targets are. It's really helpful to me. Again, methodically, systems, routines, plan everything out. Nothing is left to chance. Everything is planned and prepared ahead of time. I know what I'm doing. I have a plan, then I just trade my plan. I'm just literally trying to plan and prepare as best I can for the next session every day. That's all I'm trying to do. Plan and prepare as best I can for the next session, and then when that session's opened, just execute my trading plan as flawlessly as I possibly can and make no mistakes. That's what I'm trying to do. And just do it one day at a time for decades and decades and decades and decades. So let's now play this forward, okay? So we're just going to go on the 1 hour chart here, okay? So I get filled on this bar here, and now let's just say that we get perfect execution just because it will make it easier here. So this isn't the price that I got filled, but for the purpose of this, okay, we'll just do it like this. So let's say we got filled at 237.30. We got absolutely perfect execution, which again is rare, okay? So now I can just remove these levels and walk you through it. So now what I know is my initial stop loss is here at 234.34. Why? Because when price goes through that level, I get pinged, it gets triggered, okay, automatically. If so, it's a buy stop limit order. So think about the buy stop as the trigger price. So when price moves through that level, that's the trigger, and then the limit order goes in, and interactive brokers will do their best to fill you at the next available price. You can use different kind of entry systems and things like that through interactive brokers, but let's not go down there at this moment in time. Okay, and then my stop loss is attached to that order as well. So in interactive brokers, if you guys use it, that's not a recommendation, but you can click advanced, you can then attach a stop loss, and I will do it on a good till cancel basis, GTC, and the stop loss goes down here. So now I'm in the position, and my risk on the trade is 1.25%, which is pretty favorable versus the ADR, which is about 2.2%. You see it's just increased given the nature of this bar here. Now again, what was my expectation? Well, the expectation is this stock could go up its ADR percentage and it could go up a little bit more. But as this bar plays out, I've now got a couple of options. So let me list those options out. Now I'm not going into the weeds, but trading's in the weeds. You want to do anything at a high level, it's in the details. Like, it is really, really in the details. So I know some people will tune out and go like, oh, it's boring me, I don't care about, like, it's in the details. Those of you guys that get the details, I think you'll probably be better traded. So what I could do is I could sell half here, and I will use a sell limit order to do that, or I could have a sell limit order in for 1/3 of the position here. This is a scenario. So already within this first 1 hour candlestick, I could sell half of my position at 240.26, and I could free roll the trade. I've also got another option. Watch this, right? So my initial stop loss is placed down here, but what if I was to now move my initial stop loss underneath the low of the breakout candlestick? Because price shouldn't really return underneath the low here, should it? It shouldn't really return underneath the low there. So now what we're doing is we're tightening up our risk control. Okay, so my initial stop loss was down here, okay, at about around 1.25%. But now what I could do is move my stop loss up from 1.25% to the low of this bar here. So now I'm about 0.93%. Okay, interesting. Now look how my free roll targets have changed. So now what I could do is I could sell a half here, or I could sell 1/3 of the position here, right there at $241.84. So I could sell 1/3 of the position there, and then in the first hour, I've been able to hypothetically be risk-free on the trade. So I've mitigated the risk. I'm risk-free on the trade, and I've still got 2/3 of my position. Now I have no open risk on the position. Which position do you want to be in? You could be the trader who says, well, I'm going to keep my initial stop loss down here at 1.25%, and I've got my entire position, and I'm up on the trade now around about 2.25%. Okay, that's absolutely fine. Or you could be the trader that goes, actually, I've still got 2/3 of my position because I sold 1/3 here at $241. And my stop loss is now underneath the low of the day. I've got 2/3 of my position, and I've now got no risk. Which trader do you want to be? Again, as the stock starts moving out, you can create different options. You can create different scenarios for yourself. And this is about thinking it through. And it really, really is in the details. Like, trading is so much in the details. You can't be haphazardous about this. You've got to be specific. What are you trying to do? What are your systems? What are your routines? How are you executing it? It's so, so, so important. So here, as the trade starts getting out, different options open up and become available for us. So then the trade gets out, and then for me, what I'm trying to do, again, I'm an intermediate term trend follower. I ain't a day trader. I'm not a shorter term swing trader. I may be very active early on in a position because I want to get the risk out, so that risk mitigation part of the trade. But what I'm trying to do is get in, free roll it, and then sit for the intermediate term trend, riding 10-day EMAs, 21-day EMAs, and potentially the 50-day simple period moving average as well. Certainly if it's a bit of a bigger cap, larger cap stock, and the setup is a multi-week, multi-month base, and the 50-day moving average is that I may keep some back for the 50, which is a 10-week moving average on the weekly chart. I may do, I may not do. I'll adapt. And I will optimize the profits given those kind of selling guidelines and based on how does the stock previously move as well. So I'll wrap that video up there, guys. I think that was pretty thorough, pretty in the weeds as well. Gives you kind of a good insight for how I think about systems and routines, identify, control, mitigate, and optimize, how that feeds into daily routines as well, different order entry techniques, different ways to free roll positions as well, and think about it early on in positions. Again, Sun Tzu, Art of War principle, position yourself beyond the possibility of defeat. I would add as soon as prudently possible. I think it's very important, especially when in choppy and hostile market environments. So thank you very much for watching the video. Thank you very much for supporting the channel, and I will see you in a future video.